So we'll look at 4 people. These are not their real names. All confidential information has been scratched, but a lot of the policies are their actual policies along with their actual plan. So we'll cover 3 things for each person. Let's start with Dave and Maria. So these 2 I like a lot. Today, they're worth more than $100 million. They know their stuff when it comes to business. Now, how I met them is Dave initially reached out because he was interested in life insurance for the cash value. What he was attracted to was 1, it was a safe place to put money. 2, he had access to the cash value. And 3, the tax advantages. If you do everything right, it's tax-free. Now, Dave and Maria were pitched on whole life insurance before we had met by other agents, and they didn't move forward because the numbers didn't make sense. I remember the first meeting I had with Dave, what he said to one of the other agents is, "Why would I do this? It takes me 10 years just to get my money back." Another thing is, they had a secret weapon. That secret weapon was their tax attorney. Now, this person worked with billionaires. They still work with billionaires today. They've written books on tax strategies that are used worldwide. They helped design a life insurance product that is offered by one of the larger life insurance companies in the US. So they understood life insurance better than most life insurance agents. So how Dave and Maria used this person with respect to their life insurance purchase is, if somebody got through the first meeting with Dave and Maria, they'd bring this tax attorney in. And agents did not get past the tax attorney. That's why I got to meet with them, because the other agents didn't get through. So they say, "Want to meet with a tax attorney?" I say, "Sure. I don't know who this person is. Why not? Like, I've met with other attorneys before." So we start the meeting, and in the beginning of the meeting, she goes, "I don't like whole life insurance." She didn't like life insurance either. She mentioned that most whole life insurance products are front-loaded for commissions, which is true. There's products that are not, but she was true in that statement. So during the meeting, she starts grilling me with questions. What insurance companies do I use? What products do I use? What are your commission rates? And the whole time, this is on a Zoom meeting, she's firing these questions at me. Dave and Maria are on there watching. And this is how I felt. I was nervous on the inside. Now, hopefully I didn't show that face during the call. I don't think I did, but yeah, I was shaking. So during the meeting, I just did my very best to answer her questions calmly and thoroughly, showed her options, went over how the commissions worked, explained the tax limits, because I knew that's what she was interested in the most. That was her specialty. And my background with corporations did help a lot too. To wrap the story up, the meeting went well, and they got a policy. And that tax attorney that made me feel like this, well, I ended up hiring her, where now she's our attorney for me personally and also our business. We're friends now. Her name is Elizabeth. You can actually check out podcasts that we have with her on our YouTube channel. So what's the lesson from that story? The lesson is that Dave and Maria had an attorney who was also very knowledgeable in the field of life insurance that helped them with this very important decision. It was actually a $1 million decision because Dave wanted a policy, he got a policy where he funds $1 million per year. He wanted to use the cash value for his business. He really liked how policy loans work. He liked the fact that if he's got $1 million in cash value, earning 5%, and he elects to borrow, call it $500,000, he has a cost to borrow, 5% interest expense, but he still earns 5% on the full $1 million. So he gets that constant compounding. That was very attractive to him. It's a lot like borrowing against a piece of property that's always appreciating. So on the $1 million per year piece, that's how much he wanted to fund his policy with, but he didn't want to bill for that much. He didn't want to be on the hook for writing a check for $1 million every year. He didn't want that. So let's look at his policy. So here we see $1 million per year going in. The plan is currently to move $8 million total into this policy. So he funds $1 million per year. What do you see there in red? There's his premium, $100,000 per year. Remember that chart Premium and PUA were in red. Here's your PUA. Again, PUA stands for Paid Up Additions Rider. I like to refer to this as a cash dump payment. So the goal here was to get as much cash value as possible. How do you do that? Here's the specific steps if you're taking notes. 1, ask your agent for a minimum premium. Number 2, ask what the maximum PUA payment is. Next, I would ask what the top life insurance companies are. We did mention them earlier. Now, the minimum premium, specifically with those top companies, is usually around 10%. So what does that mean, 10%? Well, Dave wanted to pay how much? $1 million per year. What's 10% of $1 million? $100,000. That's how we solved for the minimum premium. He knew how much he wanted to add after we looked at different numbers, and then we backed in to a maximum cash value policy from that point forward. Now, this was really important because the discussions we had with Elizabeth, the tax attorney, really centered around how to get the most out of the cash value. And what she knew is that a maximum cash value policy results in minimum commissions for the agent. So she would always go there during the conversation because she was protecting her client in this case. So back to the policy. The first year, what do you see? 92% in cash value. Remember what Dave said about one of the earlier agents he met with? Why would I do this? It takes 10 years just to get my money back. It doesn't make sense. How long does it take to get his money back here? 4 years. Now his actual policy, because this is an updated version of the product, his actual policy broke even in year 3, so a year earlier than this. After he funds the policy, he pays nothing in after age 40 in this particular example, and the cash value keeps on growing. He can keep adding money if he wants. In this example, we just stopped after 8 million because that's the current plan. What else did Dave want to see? The policy performance. Not just a surface level illustration of what we just looked at, but he wanted to know what the cash value was growing by in terms of rates. The yearly rate of return and the internal rate of return. We'll go through what those are too. So first, let's talk about the rate of return, which is our annual rate of return. If you asked me, what did my cash value grow by last year? This is what I would show you, the annual rate of return. For example, if you had $100,000 in an account and it earned 5% that year, it would have grown to $105,000. That's the 5%. So when we look at this policy, or any life insurance policy, the worst year is the first year. So in the first 2 years, he's negative. That means he's getting less back than what he's paying in. But after that, it gets stronger with time. He's positive beginning year 3. And remember, this is a safe place you can put money that is tax-free. What about the internal rate of return? Well, if you asked, what is my return since starting the policy, this is what I would show. What it mainly highlights is our break even here. So we're looking at total cash flows going in. The first 3 years I'm negative because I have less money in cash value than what I've paid into the policy. By the 4th year, on the far right, you're at 0.10% because you have more money in cash value than what you paid in the policy. Make sense? I'm negative until I get my money back. It does get stronger with time, and remember that it is tax-free if we do everything right, if we don't trip the IRS guidelines and trigger what's called a MEC with a life insurance policy. So the fact that those rates you just saw are tax-free, how valuable is that? Well, the higher your tax rate is, the more valuable a tax-free benefit is. So Dave is in the highest tax bracket when we look at it, 40%. So if we look at age 40, what do we see here? Taxable equivalent of 9.46%. Does that make me sound smart? No, I hate when big words are used, but this is important because you will see this term regardless of the policy size, if you want to see what the taxable impact is. Here's what this means. If you earn 9.46% in a taxable account, and you have to pay a 40% tax rate on that account, on the earnings of that account, after you pay taxes, you would be left with 5.68%. Make sense? Cool. So I can take on risk to get 9.46%, or I could just put it in life insurance because I've got the safety and the tax benefits. Full transparency, Dave has both. He's got a lot more going on than just this. And you'll typically see that with wealthy individuals and families. Never are they putting all of their eggs in one basket. They start out in a business a lot of times, but then they expand from there. So his first priority was getting the cash value right. What about priority number 2? Placing the policy in Dave's estate plan. So Dave did not own the policy directly. It was not owned in his name. Elizabeth, the tax attorney, set it up through what's called a family LLC, and that family LLC owns the business. The LLC is registered in a state that has favorable asset protection laws. And then the LLC is part of Dave's trust, which is not even in the United States. He also has assets that are diversified in the US and worldwide. Sound complicated? It is. Why is it so complicated? Because typically we like things simple. Well, when it comes to asset protection, what I've seen with most tax attorneys, especially those that are very good, is they usually have a very complex structure set up for this reason, asset protection. So here's an example of what asset protection looks like. You got a lot going on. Right? You got Dave and Maria up top, you've got the main trust in Europe, and then you've got stuff going on all over the place, and this is outdated too. But then you've got the life insurance there under the family LLC on the bottom. So why do they have life insurance when they don't need it? Because they don't. Cash value is what they're primarily interested in. The money grows safely, they can access it like a personal line of credit for their business, and the tax advantages are very appealing to them. Next, generational wealth. If Dave dies, Maria gets a big death benefit. Here we've got $50 million. His death benefit as of today is like $41 million and change. It's a big dollar amount. When he's 85, it's going to be more like $100 million. That's if he just funds the $8 million. If he keeps adding more to it, it's going to be even bigger. If Maria gets that death benefit of any dollar size, does she have to pay income tax on it? No. What about estate taxes? Because a $50 million death benefit is over the estate tax limit. No. Estate taxes typically do not have to be paid based on the laws today if money is passed to your spouse. I'm a tax attorney. This is just based on my experience and what I've seen, and if we look up any laws. Next question, or next point. What if they have kids and Dave and Maria die? Do the kids get this $50 million death benefit? How do the taxes work? This is hitting on the generational wealth piece. Do they have to pay income tax? No. Life insurance proceeds are always paid income tax free. Do they have to pay estate taxes? They would. Now, this is where a tax attorney typically comes into play. They might recommend a different strategy where it's trust owned. I've seen strategies where a trust owns a big life insurance policy and the death benefit proceeds are used to pay the estate tax. There's a lot that goes on, and a lot of times these change over time as tax laws might change. So this is something that we would definitely keep up to speed on and work with anyone's attorney that is helping facilitate this plan. How can you copy and paste what they do? Number 1, interview multiple agents. That's what they did. Number 2, bring in a third-party expert who can make sure that you're not being taken advantage of. In their case, they had Elizabeth. Now, if you say, I don't know an expert in the field of life insurance, that's okay. What I would do is start out by just asking a few friends or family members who are familiar with just finance, maybe some experience with life insurance, and ask them for their thoughts. Because a lot of times what happens when I do that is I get an outside perspective that just helps me think a little bit differently or maybe see something that I was missing on my own, even though it was right in front of my face. You ever feel like that? And then number 3, get a flexible policy. He can pay how much? Up to $1 million per year. Is he committed to that? No. His commitment is $100,000. A lot of info. Let's move on to the next two family members here, Tina and